How's it going, Martians? Welcome back to another report. And in today's report, we're going to cover an article from Reuters talking about the repo market. But before we do that, if you're new to my channel and you like learning about the financial world and about cryptocurrencies or about advancing tech trends, be sure to hit that subscribe and ring that bell. Also, I appreciate everybody who likes the video, but if you'd rather hear the content first before you make your decision about the like or dislike, I understand. Just please don't forget to hit it at the end. At any rate, jumping into the article, it's titled, Repo is Wall Street's Big End-of-Year Worry. Why? Well, the $2.2 trillion repurchase agreement market, also known as the repo market, is part of the inner workings of the U.S. financial system, and it is facing what could be another strain as the year comes to a close. That in this strain could have wider implications on more than just Wall Street. So, a flash stress in the market in September meant that cash available to short-term borrowers all but dried up as demand for funds to settle treasury purchases to pay corporate taxes overwhelmed loans made available in the repurchase agreement repo market. So interest rates in the U.S. money markets shot up to as high as 10% for some overnight loans, more than 4 times the Fed's rate. So to put that in English, or to rephrase that, the repo rate over one night, the interest on those loans more than 4 times, or more than quadrupled, right? And so that caused all kinds of hysteria and led to the Fed starting to do this repo bailout, essentially bailout that they've been doing, where they've been pumping billions, tens of billions of dollars into this market every day. And there are other people in the YouTube community who cover finance who have actually followed this trend and shown that the numbers that we're going to read are actually very tame and undersell just how much money is actually being lent on a daily basis. But we'll get into that after we read through the intro here, right? So since September, the Federal Reserve has offered daily operations where it injects liquidity into the overnight market, in addition to frequent offerings of longer-term loans. So it is the Fed, and that's actually important to keep in mind, is the longer-term loans that they are offering. But it is the Fed's first major market intervention since the financial crisis more than a decade ago. Whether it will be enough to offset the traditional year-end strains will be tested next week, when companies will again face tax obligations, while $78 billion in treasury supply will also need to be settled. At the end of year, there is also typically a reluctance by banks and fund managers to lend, which can leave borrowers struggling to raise cash. Some fear that structural problems with the market leave it vulnerable to periods of stress. The Bank of International Settlements said last week that growing reliance on the biggest U.S. banks to keep the repo market functioning may have been a big factor in September's cash squeeze. The big 4 banks, which Bank of International Settlements did not name in its report, have become net providers of funds to repo markets, as they account for more than half of all treasuries held by banks in the United States at the Federal Reserve. So, who are those 4 banks? If you don't know, allow me to inform you. They are JP Morgan, Bank of America, Citibank, and Goldman Sachs. So, it doesn't say in this article, I can almost promise you, but those are the big 4. To also go into details about this $78 billion that they mention here, it is not simply $78 billion that they're lending every day. That's simply the amount that they are doing in daily repurchases, right? They mention up here that they're also offering longer-term loans, and those longer-term loans are many of them are on a weekly or bi-weekly lend rate. And so there is a YouTuber named Road to Ruda. Definitely check out his content. Fantastic individual, and he's been covering this for some time, and he's been he's created a metric that is measuring just how much money they're actually lending every day. And last I checked, it was his last video, I believe, on the 10th, measured that we were lending, or that the Federal Reserve was lending over $360 billion every day. Now, $360 billion into a $2.2 trillion market. That means that the Fed is now lending nearly 20%, almost 20% of this market. I think it's probably technically about like 15 to 17%. They're actually lending into this market right now. And this Reuters article is breaking down that that's still not enough. These banks, because they're coming up to the end of year where they've already for the last several months been concerned or, tight-pocketed about lending to each other, have now decided that, because they're coming up to the end of the year where they have tax obligations, they aren't going to want to lend they're going to be even more frugal about lending to each other, meaning that the Fed is now going to have to take even more drastic measures than lending 18% of the funds moving through this market on a daily basis. Okay, so let's get into why Reuters says the repo market is important. So the repo market underpins much of the U.S. financial system, helping to ensure banks have the liquidity to meet their daily operational needs and maintain sufficient reserves. In a repo trade, a borrower offers U.S. Treasuries and other high-quality securities as collateral to raise cash, often overnight, to finance their trading and lending activities. The next day, they repay their loans plus what is typically a nominal rate of interest and get their bonds back. In other words, they repurchase or repo the bonds. The interest rate charged on repo deals typically stays close to the Fed's benchmark overnight rate, currently set in a range of 1.5 to 1.75. Now, it said earlier that this was only the 10% jump was only 4 times greater than the Fed's rate, but anybody who knows basic math knows that even a 1.75 is actually closer to a 6 times smaller rate than 10%, right? You can put 1.75 into 10 nearly 6 times. 1.5 definitely goes in at least 6 times. So to go on, when investors become fearful of lending, as seen during the global credit crisis, or when there are just not enough reserves or cash in the system to lend out, it sends the repo rate soaring above the federal funds rate. So is that what happened back in September? Well, at any rate, trading in stocks and bonds can become difficult. It can also pinch lending to businesses and consumers, and if the disruption is prolonged, it can become a drag on the U.S. economy that relies heavily on the flow of credit. September's funding strains did not spread to other markets. However, a prolonged disturbance or a weak economy would increase the risks of contagion. So the Fed seeks to increase bank reserves. A reduction in excess bank reserves, cash held at the Fed, that can be made available for loans, was also cited as a large contributor to September's repo stress. JP Morgan, in particular, cut the cash it holds on deposit at the Fed by 57% this year. That's huge, actually. At any rate, coming out of the financial crisis, after the Fed cut interest rates to near zero and bought up more than $3.5 trillion in bonds, banks built up massive reserves held at the Fed. But that level of bank reserves, which peaked at nearly $2.8 trillion, began falling when the Fed when the Fed started raising interest rates in late 2015. They fell even faster when the Fed started to cut the size of its bond portfolio about 2 years later. To reverse this decline, the Fed has been purchasing Treasury bills since October. When the Fed buys securities from a bank, it credits the bank's reserve account, which increases reserves in the system, which essentially allows them to lend greater amounts out. Now, banks, being the greedy, for-profit institutions that they are not just going to stop lending more. Instead, the Fed is enabling them. They are incentive, because the Fed will not allow these institutions to simply have to eat crow, to face the reckoning of their less than credible lending practices, we'll say. By lending to them, the Fed is actually enabling these banks to continue to perform risky loans, risky lending processes, which has led to this need for a bailout, which has led to this reduction in trust between private banks and public banks, right? So the madness of this is that it is blatantly clear to anybody who understands basic economics, basic movement of funds, and how the repo market actually underpins the entirety of the global economy, that this is only going to end in one of two ways. Either fear is going to set into the market and the markets are going to crash, which is going to result in a run on the banks, which is going to result in the government most likely either A, bailing out the banks, which is going to lead to inflation. I won't say hyperinflation, but that is a potential threat in the situation we find ourselves in now. So inflation, potential hyperinflation of the dollar, or they're going to enact austerity measures, which is going to absolutely devastate the Main Street economy, meaning you, as an American citizen, are likely going to lose your job unless you are self-employed. But if you're self-employed, if you run a small business, you're likely going to watch all of your customers stop showing up because they don't have the money to go and eat out. They don't have the money to engage in the economy. They don't have the ability to go grocery shopping because they lost their job. This is the definitive rock in a hard place that the Federal Reserve now finds itself in between. And by all appearance, it seems that the Fed is looking to choose the route of risking hyperinflating the dollar as opposed to allowing the economy to enter into potentially a Great Depression 2.0. They'll probably try and label it as a recession at the start, but what we're in right now as a 12-year bull run is utter madness from economic standpoint. We have never experienced a bull market that lasted this long. This is more than twice the length of the average bull market, and it is being prolonged through efforts such as what we've just covered with the Fed bailing out the repo market. And it appears that the Fed intends to continue to inflate this bubble until they can't anymore. And the big downside, the scariest part of this is when this pops, because the Fed is taking such drastic actions right now to keep the market just in the range that it is, to keep the Dow Jones above 26,000 and the S&P still trying to climb, stay above 3,000, stay above 2,900 or 2,900, we'll say. Their efforts to keep this bull run going are actually reducing their ability to prevent an utter catastrophic collapse, because they are running out of every means possible to soften the crash. Instead, they're trying to inflate this market as high as they can. They're being very short term without any consideration for the long term, which indicates that they either do not have any faith that there is any solution to the long-term problems facing the economy, or they intend to destroy the dollar to implement a new currency into American possession. Now, there is a new Federal Reserve note that has been circulating. You can Google new Fed note and see what the new dollar is going to look like. And we're also witnessing on a global stage as many countries are fleeing from the dollar. So it appears that on a global stage that the whole world is pivoting away from the dollar, but nobody is telling most American citizens that this is what is unfolding. So it's a terrifying time to be an American citizen. It's actually one reason why I am as far away from the States as possible right now out here in Malaysia, because I am so fearful of what is going to happen to America over the coming months and into 2020. So hopefully I'm completely wrong and I'm able to return stateside, mid 2020, and the economy will be doing all right, and maybe we'll just be stagnant, right? Best case scenario. But all indicators seem to shine on the fact that this bull market is at its peak, and the Fed is doing everything in its power to keep the lights on. So hopefully everybody out there who's watching this, who understands the peril that the U.S. economy is facing right now, has planned for the potential of a market collapse, and has positioned themselves so that they are defensive investments such as physical metals, and again defensive investment options. I'm not a financial advisor, so I'm not at liberty to disclose what I think that you should be investing in. Obviously, everybody knows that precious metals are the way to go for a collapse. That's common knowledge. Other means you should ask a financial advisor how to stack your portfolio defensively. So with that said, I hope you guys have all enjoyed this video. Once again, if you haven't already, be sure to hit that like on your way out, and the subscribe and bell if you're new. Why haven't you already hit that? I'm out here trying to provide the most objective and insightful content possible. While, again, I am not a financial advisor, I have spent quite a number of years researching and studying this space as a independent researcher and now independent journalist. So if you enjoyed my content, leave me a comment in the comment section below. Let me know what your thoughts are on what we're watching right now. If you think that I'm over the top, maybe a little bit paranoid, maybe a little bit conspiratorial with what we're witnessing, please explain in as many words as possible so that I can understand your position. If you agree with me, maybe send me some links to what you're seeing if you are excited to see me starting to talk about this kind of content. I know that I'm typically have been only covering XRP and very rarely touching on the greater market, but now that I'm out in Malaysia and I have the liberty to expand my content that I provide for you, we're going to be covering all kinds of new areas that I feel comfortable in providing insight to. So I can't wait to see all of you guys in my next video, as always, on Mars.